Hello and welcome to Real Commercial Propcast, the commercial property podcast where we look to answer the most common questions for anyone on the commercial property journey, whether you're an investor, business owner, or somewhere in between. The topics we discuss are of general nature only and don't consider your personal objectives or financial situation, so it's always best to obtain independent advice before making any commercial property decisions. Hey there, I'm your host Tessa and I'm the Head of Product at Real Commercial Australia. And as always, I'm pleased to be joined by my co-host David Story, who has spent many years in the commercial property industry working across all asset classes in marketing and communications. David, hello.
Hi Tessa, great to be here and looking forward to the third episode of our series. What are we talking about today?
Well, today we're exploring a topic that I'm personally really excited about. I'm actually looking to expand my portfolio into commercial property, but I'm finding that in my research phase, there's so many factors that are different to residential property. So we're tackling a topic that I selfishly am very interested in, but I know that many other new investors will be interested in as well. And that's the top 3 questions an investor should ask when investing in commercial property. So we'll cover off capital growth, cash flow, portfolio growth, location versus yield, topics like that. So really it's the 101 to get you started when thinking about investing in commercial property. So David, who's our expert who's going to help us delve into this topic more today?
Yeah, it's a fascinating topic and one I'm certainly looking forward to learning more about myself. Today, we're being joined by Mark Wizel, who is Managing Director and Chief Executive Officer of Wizel Property Group. Now, if you want to find out the answers to the top 3 questions an investor should ask when considering commercial property, then there wouldn't be many people better placed to provide you with advice than Mark, who is considered to be one of the leading commercial property investment specialists in the industry. So before setting up Wizel Property Group, Mark developed a market-leading reputation over 13 years at CBRE, where he built a team of specialist commercial property agents. And when that team was at full strength, they transacted just under $15 billion in commercial property over a 7-year period, which is pretty impressive. So now he and the team at Wizel Property Group help investors answer the exact questions we're looking into today to ensure that there's no value left on the table at the end of the deal. And they specialise in the acquisition and development of commercial real estate, primarily focusing on the retail, office and development sectors. So good morning, Mark. Welcome and thank you for joining us on the Real Commercial Propcast.
Morning, David. Morning, Tessa. Thanks for the glowing introduction. I'm starting to blush.
Thank you, Mark, and so good to have you here with us. So first off, let's start off with capital growth. So that's how much the property value will increase over time. It's one of the key factors that most people look at when building their wealth through real estate, because essentially, if you do your research and you make a smart investment, you can kind of make money over time without even doing anything. But of course, that can take time over longer term growth or may not even be guaranteed. So as an investor, what sort of questions do I need to ask if I want to achieve the best possible capital growth?
Well, it's a great introductory question. I mean, I think that what I would disclaimer from the start is if I've learned anything about property and property investment, in my years in the business, it's a get wealthy slow game. So, for those that are out there thinking that, they're going to make immediate sort of capital growth or capital gains, by just entering the market, they might, look to reassess, what the sort of goals are of why they're looking for property in the first place. So I think, when it comes to commercial property, in particular, if you pick your mark correctly, it can certainly be a way in which your overall net value and net worth can be increased over time. But very rarely are there situations where you can have an immediate, massive capital uplift. So I guess it needs to be, when you're investigating, the potential to enter commercial property investment, probably needs to go back to what your overall strategy, from an investor point of view is, whether that's as a family investor or investing, as an individual investor. And make sure that properties that you are looking at sort of in the commercial space dovetail into the direction in which you want your sort of life to head in the next 10 or 15 years. So for those that are seeking steady returns, there's certainly sectors within the marketplace where you can link some logic to steady returns. So a great example at the moment would be healthcare. So if you look at what the world's going through, if you look at aging population globally, and in Australia, It wouldn't take too much logic to work out that if you're buying a property leased to someone providing a healthcare service, that it's going to be quite a good investment. Tess, I guess ultimately when we talk about capital growth, in terms of commercial property, it all comes down to income growth. So that's where a really big opportunity can be, in commercial property versus residential property, in the sense that if you can pick the right sector and you have a tenant within your property that has exposure to a sector that's growing or has a very profitable business, the way that commercial tenants look at their rental is that their rent is a function of their overall operating cost. So if a business is doing better in 5 years from now, from when they started, there will be difficulty for them to, as long as the property is still big enough for what they need, there's a lot of disruption for them having to pick up and move that property to another location. So quite often what that will mean is they'll sit down with the landlord and say, well, look, our business is going really well, we would like to stay. And quite often that will mean that the landlord might be able to increase their rental. And obviously as you get an increased rental, on the basis that the yields stay the same as what they are when you bought the property, more rent, same yield equals higher capital growth.
Thanks, Mark. It's interesting. I mean, obviously you're saying that a lot of research needs to be done in terms of looking at what sort of property you're going to invest in and looking at the industries as such and how they're being impacted by the economy. But you touched on rental, yield or cash flow, and I wouldn't mind exploring that, the yield or cash flow in considering what you've just told us about capital growth. Yield's obviously a measure of how much cash flow an income generating asset produces each year as a percentage of that asset's value. But as an investor, as part of my decision making process when I'm looking at a property, what sort of a balance should I place on cash flow, and capital growth, or cash flow versus capital growth?
Good question. So just for the audience, it's important to sort of understand. So when we talk about yield in commercial property, or we talk about yield in residential property, the best way to sort of define it is it's a fancy word for return. So ultimately, if you've ever invested in a bank account, a term deposit account, the return that they give you as your fixed interest return on your money invested. So you might invest $10,000 at a 10% return, and then obviously you're getting $1,000 a year as your return, which effectively is a 10% yield. So yield is a term that not everyone looking at investing into commercial property for the first time might be au fait with, but the best way to look at it is what is the return that you're obtaining on an annual basis from your capital invested into that property. To answer the question specifically, David, it really depends on whether an investor is using bank finance or not. So if an investor is buying a property purely with cash or with equity, then there might be something to suggest that the cash flow of that property is not as critical. Whereas if an investor is borrowing money against that property and they're relying on the cash flow coming from that tenant in order to service their loan, then I would say it's absolutely the most paramount thing that an investor can think about. Because ultimately, the process to go from losing a tenant to finding a new tenant can be a long one. It can be a costly one. And certainly for the investors out there that are sort of a little bit less experienced than the people that have been doing it possibly for a lot longer, there is a level of expertise required when you've got a vacancy and then you're having to lease the property. So if you are borrowing money, whether it's 50% or 55 or 60% of the property's value, and you're going to need the income from the property you've bought from the tenant who occupies the property, then it's very important that you do your due diligence and that you look at all the worst case scenarios. I think that a lot of investors tend to look at what the best case scenario is. And certainly as I've moved away from being a real estate agent at CBRE for nearly 15 years into an investor and developer role, my first port of call when I look at any new property is what's the worst case? So what's going to happen if this tenant can't survive? What's going to happen if there's government changes to the industry that apply to this tenant? I try and work out what the worst case is, and then if I can live with that, I start to look at what the possibilities might be for future profit and future capital growth.
Okay, so in residential property, often yield is associated with location. Is that a factor that comes into commercial property at all when we're thinking about the return that a commercial property can give us?
Yeah, that's a great question, Tess. So interestingly, over the past 3 years, the answer would be less and less. And I'm not sure that that's actually a good thing. So what we're experiencing at the moment, in all money markets, whether it's, the stock market, whether it's the commercial property market, is there's a massive flow of capital. And there's so much capital out there looking for investments, looking for return, that what tends to happen is people start to forget about the fundamentals. So what we're seeing nationally at the moment is investors willing to accept a return or a yield in regional locations, which are very similar to metropolitan locations. What investors are seeking as their paramount guiding sort of light as to what they would pay for a property is the security of the cash flow coming from the tenant. So, for example, if you are buying a property and it's leased to a tenant that's Australian Stock Exchange listed, that is seen to be a really large tenant, a safe tenant, investors are basically saying, say in Victoria, we're happy to pay the same yield for a property in Bendigo as we are for a property in Brighton, as long as we're getting that cash flow. Now, the danger with that is the land value in Bendigo versus the land value in Brighton is probably 25%, Bendigo to Brighton. So in essence, what one would say is that investors most likely paying too much of a premium for the cash flow coming from the property. It should certainly, circling back specifically to the question, there should certainly be a differentiation in the acceptable yield that an investor is willing to take based on location. But at the moment, there's just too much money in the marketplace, and that is affecting how investors are perceiving fundamentals.
Okay then. So changing gears a little bit, we've been talking today so far about people making one-off commercial investments, but there are a lot of people who, like myself, already have existing residential property and are now looking to add commercial property to enhance the total value of their property portfolio. So they're looking to diversify and ideally chase down returns that they wouldn't necessarily get in residential property. It's something we spoke about in an earlier episode about the differences between choosing to invest in commercial instead of resi. But that aside, if we consider those factors such as capital growth and cash flow, location versus yield, what sort of questions do I need to ask or should I research as an investor when considering my total portfolio growth?
Total portfolio goes. So obviously, people should seek professional advice, whether it's from a financial planner or whether it's from an accountant, in terms of what's best tailored for their specific portfolio. In relation to, commercial return or commercial yield versus residential, as I sort of mentioned before, if you can pick the right property and the right tenant sort of in a sector that's got growth, then there's going to be accelerated rental growth for that commercial property versus what is a steady sort of increase for residential property. Ultimately, if you're buying a house or you're buying a flat or you're buying an apartment, there's only sort of so much that the rents can go up sort of on an annual basis. And obviously, if there is an oversupply of residential, we've seen rents come down quite specifically as well. It's not to be said that residential property is that much of a safer bet. I think if we look at what's happened over the past couple of years with COVID, residential property capital values have been high in terms of established property, but I dare say that the returns for, say, CBD apartments have gone down a lot because the international students, the international tourists, the international working visas have all come down. So it's all about sort of trying your best to sort of read the tea leaves. And for example, at the moment in commercial property, would it be prudent for one to be going out buying a shop lease to a fashion tenant? And the answer would probably be no, because there's this massive adaptation for fashion to go online. That people are doing much more shopping online for fashion. However, if you look at the way that food and beverage tenants and cafes were still able to trade through the pandemic, it would be a pretty safe bet to say that, food and beverage and cafe and takeaway shops and, food shops that are exposed to home delivery would be a fantastic place for first-time investors to be looking at parking their money. Now, Tessa, as I sort of said before, if you've got a tenant in a commercial property who has a great business, in terms of food, and they go online, they go into Uber Eats and they go into Deliveroo, and they become a big hit within, the local 5-kilometre population. Now, they may not have thought about doing delivery when they took that shop, but suddenly their business has gone from being a bricks and mortar tenancy where people walk in and buy product to a bricks and mortar tenancy plus basically an outlet for delivery. So that means if they're selling more pizzas, in essence, they want to keep their business going in that premises, which in time will mean they can pay more rent. So it really all comes back down to the way in which the income profile of a commercial property can rise over time, and that effectively is going to drive returns. We know firsthand that commercial property tends to return higher sort of percentages on a per annum basis than residential. It would be getting to a stage now where you'd arguably sort of be saying, well, why is that? Is that just because that's how it's been, for the past sort of 30 years? Is that because residential's a more accepted product because people seem to understand it more than commercial? And on that point, I think Real Commercial in particular are doing a fantastic job to actually educate, the investors that are looking to get into the market, because ultimately it's really not that complicated. If you look at the change to the Residential Tenancies Act, post-COVID in Victoria, and I happen to have, quite a few small flats, and the amount of paperwork and admin involved now in finding a new tenant or doing a renewal with tenant, I actually think it's getting easier to own commercial properties. And if that means it's easier and you get a better return, then a lot more people should certainly be looking at commercial property as an investment class.
Mark, interesting that you say that it's becoming easier, because you've definitely given us some fantastic lessons for our listeners to go away with today. It's quite obvious that they do need some professional advice along the way, whether or not they need to be listening to their financial planner or their accountant, or whether or not they need professional viewpoints from people like yourself. Especially the point you made about cash flow, and whether or not it's your borrowed money to actually invest in that property, or whether it's come from cash flow itself. But let's talk about timing as an investor. If I want to get into the market now, you just mentioned COVID, but if you look at the post-COVID climate in Australia, and it has sort of supercharged the commercial property industry as such. Its interest rates are low, so cash is cheap. Although we have been hearing about the Reserve Bank looking at increasing that over the next couple of years or so. There's a high quality of commercial assets that are now scarce due to increased demand, and probably because people have got more savings. They've been forced to stay home for a long time. They're now looking to put their money to work, and all of these factors have contributed to a tightening of the market and have resulted in yield compression for commercial property or capital growth. But in terms of timing for our listeners and anyone who is looking to start their commercial property journey, is now a good time to get involved? What are we likely to see over the next 12 to 24 months?
Look, it's a fascinating question, and it's arguably, I would say one of the most popular questions spoken about at dinner parties. On the residential side, like, is it a good time for us to buy a property? Should we be buying a house now? Is it a good time for our daughter or our son to be entering the market? I'm a big advocate, circling back, right back to the initial question that Tessa had. And that is that, I believe any type of investment should be looked at, on a long-term basis. For example, I don't look at the equities markets too much, because for me, they just create too much anxiety, because it's sort of a day-to-day business, whereas, property is sort of more a year-to-year business. So I would say that, the best thing to do is get started, David, but on the basis that you're taking a 3 to 5, or 10-year view that you're actually going to become an investor. And becoming an investor means that, you have an active interest in a particular sector, or, in a particular type of product. It's not necessarily, I'm going to just buy that property and never think about it again, because as we've spoken about today so far, the ability to identify trends, the ability to look at world affairs and then break that down into particular sectors like healthcare or childcare, or, what is the federal government going to do at the next budget? There's a lot of talk about how much money is going to flow into the childcare sector. So an investor could look at that and say, well, that's probably going to be a pretty good bet. If they're going to help the operators subsidise, more kids to come to their offering, then as an investor, I'm going to be pretty confident that my tenant's going to be able to pay me the rent. procrastination, is an issue generally speaking, in society, but certainly is one that is rife in property, whether it's residential or commercial. All I would say is, there's no get rich quick schemes. You need to do the work, you need to do the research, you need to be patient. You need to be commercial. So I would say if someone is, looking to enter the commercial property market without taking a massive risk at the moment, i.e. they're putting it all on the line to try and make some money, then I would say now's a great time to start. Will yields increase in the next couple of years? Well, there's no doubt they will, because, we're coming off the back of historic low borrowing costs. And we know that the lower the borrowing cost, the lower the acceptable yield is to an investor. So we're already starting to see, movements in terms of the longer term money and how it's being priced. So I do expect the cost of borrowings to increase. And that will mean that we've probably seen the peak of that low yield environment. Is it gone forever? No. We're still seeing some really strong results even at the start of 2022, and I think that will be the case. But generally speaking, it's probably not a bad thing for the industry just to, take a little bit of the heat, out of the market, because it has been an enormous run. You'll have a lot of happy clients at Real Commercial. A lot of the estate agents have, been back buying champagne and caviar on the weekend. But I was very fortunate in my career to see the end of the 2007 boom. Heading into the GFC, and we can learn a lot from history, and history in some way, shape or form does repeat itself, and I guess it just tells you that if you've been on a long run, we've been going sort of 10 years now into this really strong run, and I hope it continues, absolutely, because nobody wants anything other than stable conditions, and it's better when things are going well. But it is probably a time to just be a little bit cautious, but at the same time, there's never a better time than now to start, in terms of whether that's just starting to research, whether that's starting to reach out to some estate agents and start to know your local market. I think the great thing about commercial property is, it can really be suitable for people that know a particular area, so if you've got people that, live in Bayside, in Victoria, whether that's sort of Sandringham or Hampton or Brighton, they might know the residential market really well, but it could be a great chance for them to start to learn the commercial market, whether that's industrial, whether that's retail, whether it's healthcare, childcare. I must admit, I think these, and I'm not an industrial person, I've got no background in industrial, but I think these office warehouse properties that are being developed all around the country at the moment, where, you've got a warehouse facility with a small office, a very versatile property, quite often within a great suburb, so they're not, sort of miles out of suburbs. I think they're a really good price point asset, between 600,000 and 1.5 million. And I see, continuing demand with the way businesses moving to online, logistics, storage, that sort of thing. So, that's certainly one sector that, I would look out for if I was a, first time kind of $1 million investor out there.
That's excellent advice. And I think just starting is such a good tip. And I think maybe people listening to the podcast today have just started as well. So good on you if you're just starting out. And thank you also for the reminder that there's no get rich quick scheme. We live in this world of immediacy where we want our Uber Eats order now, and I want my Deliveroo. It's going to take 5 minutes. It's 5 minutes too long. So thank you for that reminder. But otherwise, thank you so much for joining us out of your busy schedule today, Mark. I've really enjoyed chatting with you today.
No, it's an absolute pleasure. I've enjoyed a great relationship with your organisation for near on 15 years now, and it's really the least that I can do to, I suppose, get on and share some of my experiences having moved to the investor side. So I wish all of your team a great 2022, and we thank you as industry players for all that you're doing for the property market and the investors out there, and it's a really great offering that you provide. So all the best to all your listeners, and happy investing.
Thank you so much, Mark, and good luck to you too. If you're hungry for more information on commercial property, you can check out our new section on Real Commercial, which I'll link in the show notes below. It's a great range of content from guides and advice and recent news and happenings. So do check it out if you want to read more. But otherwise, thank you for joining us for another episode of Real Commercial Propcast, brought to you by the #1 address for commercial property, realcommercial.com.au. Don't forget to subscribe wherever you listen to your podcast so that you never miss out on a new episode. Catch you next time.